Fitch Ratings, alongside the other two major credit rating agencies, have put Australia's housing market on alert, stopping short of sounding the alarm bells. But as parallels are being drawn between the Australian and Canadian economy, big question now is, could Canada's housing be next to be put on alert? Joining us now in studio is James McCormack. He is the head of global sovereign ratings at Fitch, based in London, England, but joining us now in studio. Good to see you again.
Thank you very much. Good
Thank
to be here.
you. Let's start with the parallels with what you're seeing in Australia, and does it relate to what you're seeing in Canada?
A couple of parallels. One is, it was in Australia a commodity story that led to stronger growth, attracted a lot of foreign investors, and I think that foreign investor element is consistent here as well, at least in the cities that are, the booming cities of Toronto and Vancouver. There's a large foreign element which is pushing prices higher at the top end. So I think there's a similarity there, definitely.
And what do you think that might mean, though, in terms of the outlook for Canada?
Yeah, well, the outlook for Canada from a rating perspective, it's not pertinent today. I guess when we worry about housing markets from a sovereign credit perspective, it's really, what does it mean for the banking system? Is there a lot of leverage in the banking system related to the housing market?
Okay.
If it's foreign buyers, they typically come in with a lot of cash. So you end up with higher housing prices, but you don't see that same amount of leverage being built up in the banks. I'm not saying there isn't leverage in the banks related to housing, but in this particular segment of it, if it's foreign investors that are coming in, it's not usually with leverage. So that's one issue to keep in mind when we think about housing prices moving, much, much higher.
James, that's one of the reasons that so many strategists and economists give us as to why we won't see in Canada the same housing market crash that you saw in the United States. But I had David Rosenberg on earlier. I spoke with him this morning. We played it just about 20 minutes ago or so. And he actually says that the bubble's on par with the United States here.
Yeah, if you look at prices, it is, right? Prices relative to income levels and, how long does it take you to buy a house for the average income level. In Toronto and Vancouver, certainly the numbers are very, very high. Unprecedented for Canada and on par with what we saw in the U.S.
But wouldn't that have an impact on the country as a whole? It might not be the banking system. What else would you be looking at to make changes or to think about Canada differently versus just looking at the system of their banking system?
Yeah, well, clearly the areas of potential distress would be in the financial sector if you have a housing, bubble that bursts, right? That's what we've seen in housing markets that burst elsewhere. That's the first...
The financial system.
The financial system. That's the first port of call. In Canada, the banks are fundamentally strong. When we rate them on what we call the average viability rating of the banking system, it's AA. The only other AA rated banking system that we have globally is Australia. So it's a fundamentally strong starting position in Canada. So that's why it's a little bit less of a concern.
But what next? What would be another area of distress that you would care about?
The overall macro performance, you probably see weaker growth. If you see this correction in housing markets, people feel that people feel that their houses contain wealth, and so there's a confidence effect. And if that diminishes, then you probably see some kind of reduction in consumption spending and weaker growth as a result of that. So that's the macroeconomic implications potentially.